Welcome to the Deep Dive. Today we're going to try and crack open what can feel like the secret language of business, the balance sheet.
Right.
Think of it maybe like a financial x-ray. It shows you exactly what a company owns, what it owes, and, well, the difference, which is its real net worth.
That's a great way to put it because, while everyone loves talking profits, the balance sheet gives you a much, much deeper sense of a company's staying power.
Its foundation.
Exactly. It's foundation. It's what long-term success is really built on.
And to help us make sense of this crucial document, we're diving into some serious wisdom. We're talking legendary investors like Warren Buffett, Benjamin Graham, the sort of father of value investing, Peter Lynch, champion of the everyday investor, and Philip Fisher, known for his deep dives.
A great lineup.
Yeah. So our mission today, it's really to give you a powerful lens, a framework maybe, for looking at any company's balance sheet, kind of a shortcut to understanding if it's financially rock solid or, skating on thin ice.
Okay, so let's jump right in then. Why should you, listening now, really care about the balance sheet? I mean, the income statement tells you if a company's making money, right?
Right. The bottom line.
But the balance sheet, it reveals how they're making it, and maybe more importantly, if that success is actually sustainable.
Exactly. Earnings can sometimes feel a bit like a magic show, some accounting tricks here and there potentially. But the balance sheet, because it's a snapshot at a specific point in time, it's just much harder to manipulate.
It is. It feels more grounded somehow.
Yeah, it's a more honest look, I think, at the underlying financial health. And that health, it isn't just a nice-to-have thing. It's what allows companies not just to survive the bad times, but actually thrive long-term.
Precisely. I mean, think about it. Companies with strong balance sheets just have more options. They can weather economic storms, they can invest in R&D, they can even snap up opportunities when competitors are weak.
Because those competitors might be struggling financially.
Exactly. They just can't make the same moves. And this brings us to a really core idea from value investing.
Let me guess. The famous margin of safety.
You got it.
For anyone who hasn't heard that term, what's the gist?
Well, think of it like this. If you're buying, say, anything valuable, you want to pay less than its true rate to give yourself some cushion, some buffer.
Makes sense.
A strong balance sheet helps us figure out that true underlying value. If a company has lots of solid assets and not too much debt, its real intrinsic value is probably higher. And that provides that critical margin of safety, against mistakes in our analysis or just unexpected bad news.
Okay, got it. So let's dig into the actual building blocks then, starting with assets, what the company actually owns.
Right. Assets are basically resources that are expected to bring in economic benefits later on, and we usually split them into current and non-current.
Current meaning short term.
Yeah, current assets are things you expect to turn into cash fairly quickly, usually within a year. So cash itself, obviously. Money customers owe you, that's accounts receivable. And inventory, the stuff waiting to be sold.
And non-current.
Those are the longer-term investments, things like property, plant, and equipment, factories, machines, buildings, and also intangible assets, which can be trickier, like patents, brand names, goodwill.
Okay, let's start with the most straightforward one. Cash and cash equivalents. Now, Warren Buffett, he's famous for liking companies with big cash piles. Why is that such a big deal for him?
Well, for Buffett, cash isn't just idle money. It's like a strategic weapon. He often calls it dry powder.
Right, I've heard that.
A big cash position gives a company amazing flexibility. They can make acquisitions when prices are good, maybe during a downturn when others are forced sellers. They can invest heavily in R&D, or they can just sail through rough economic patches without needing to borrow money at potentially bad rates.
So it's about options and safety.
Absolutely. Flexibility and safety.
Now, Benjamin Graham, Buffett's mentor, he had a slightly different angle on large cash holdings, didn't he?
He did, yeah. Graham sometimes saw a large amount of cash, especially relative to the company's stock market price, as a potential sign that the company was undervalued.
How so?
His thinking was, well, if a company is trading for not much more than the cash it has sitting in the bank, maybe the market is just ignoring the value of the actual ongoing business. He figured that cash could eventually benefit shareholders, maybe through dividends or buybacks, or just be used better within the business itself.
Interesting. So when we're looking at a balance sheet, what should we be watching for with cash?
Well, ideally, you want to see a trend. Are their cash holdings generally increasing over time? That's often a good sign. But maybe even more critical is comparing that cash to their current liabilities.
The short-term debts.
Exactly, the debts they need to pay off soon, within the year. Do they have enough liquid assets, like cash, to comfortably cover those? If they seem to be constantly scrambling to meet short-term obligations, that's definitely a potential red flag.
Okay, let's move to accounts receivable then. This is the money customers owe the company. Graham watched this closely, you said.
Yes, he really did. Graham understood very practically that a sale isn't really a sale until the cash is collected.
Right, until it's in the bank.
Exactly. So he'd look very carefully at how accounts receivable compare to the company's total sales. And crucially, how that relationship was changing over time.
What would be a warning sign there?
Well, if receivables suddenly jump up as a percentage of sales, it could mean a few things. Maybe the company's getting worse at collecting its bills, or possibly worse, maybe they're boosting sales by offering really easy credit terms to customers who might not be able to pay later. That can lead to bad debts down the road.
So the key question for us looking at receivables is...
It really boils down to efficiency. Is the company collecting its money effectively? There's a metric for this called Days Sales Outstanding, or DSO. Yeah. It basically tells you the average number of days it takes to get paid after making a sale. If that number is consistently high, or if it's climbing, it suggests there might be problems with collections or maybe even the quality of their customers.
Got it. Okay, next up, inventory. This is obviously key for companies selling physical goods.
Right. And Graham looked at how fast a company sells its inventory. That's kind of inventory turnover relative to its sales. He saw high turnover as a possible sign of a competitive advantage.
Meaning their products are popular and moving quickly.
Exactly. It suggests demand is strong and they're managing their stock well, avoiding storage costs and the risk of stuff becoming obsolete. But he also warned about inventory growing much faster than sales.
Why would that be bad if they have more stuff to sell?
Well, if inventory is piling up on the shelves while sales are flat or slowing down, it could signal that demand is actually weakening. Or maybe they have a lot of old, unsellable goods. Or maybe their inventory management just isn't very good.
So you want inventory to move efficiently.
Precisely. There's another metric, Days Inventory Outstanding, or DIO. It's the average number of days inventory just sits there before it gets sold. A rising DIO can be a warning sign that they're struggling to shift their products.
Okay, let's pivot to the longer-term assets now. Property, plant, and equipment, PP&E. The factories, the machines. What are we evaluating here?
The main question is, how efficiently is the company using these big, expensive assets to actually generate sales? A useful ratio here is the fixed asset turnover ratio.
How's that calculated?
You just divide the company's revenue by its average fixed assets over a period. Generally, a higher ratio is better. It suggests they're really sweating those assets, getting good bang for their buck in terms of sales.
And a declining ratio.
Could mean assets aren't being used effectively, or maybe they've overinvested in capacity they don't need right now.
Okay, and the last bit in assets, intangibles. Things like goodwill, patents, brand value. These seem, well, less tangible, harder to pin down.
They definitely can be. Both Graham and Buffett approached intangibles with, let's say, a healthy dose of skepticism, especially goodwill.
Goodwill usually shows up after an acquisition, right?
Exactly. It's often the amount paid over the fair market value of the identifiable assets acquired. And the value assigned to goodwill and even other intangibles like brand names can be very subjective and sometimes potentially inflated.
So what's the key takeaway for analyzing intangibles?
I'd say be cautious. Be wary if a company has huge and rapidly growing goodwill, especially if it's a big chunk of their total assets. Don't just accept the number on the page. Trying to figure out if these intangibles are really creating a sustainable competitive advantage, what Buffett famously calls an economic moat.
Does the brand let them charge more? Do the patents actually protect something valuable?
Right. Is there a real economic benefit? Or is it just an accounting entry? Also, watch out for something called goodwill impairment. If the acquired business doesn't perform as expected, the company might have to write down that goodwill, which hits their earnings directly. So it can come back to bite them.
Absolutely. It's a big reason Buffett is so careful about not overpaying for acquisitions in the first place.
Okay, super helpful. We've covered what the company owns the assets. Now let's flip to the other side. Liabilities, what the company owes.
Right. Liabilities are basically obligations the company has from past events that mean they'll have to give up some assets in the future, usually cash. They're typically split into long-term, like bonds due way down the road, and current liabilities, which are due within a year.
And we mentioned Buffett likes low debt. He has a strong preference for minimal long-term debt specifically. Why is that so critical for him?
Well, for Buffett, lots of long-term debt just introduces risk and inflexibility.
Hmm.
He really dislikes that. Think about it. A company loaded with debt is much more vulnerable if the economy turns down.
Because they still have to make those interest payments. Exactly. Those fixed payments, maybe principal repayments too, they don't go away even if profits dry up. High debt can also stop a company from grabbing opportunities or making needed investments because all their cash flow is just going to service the debt.
So low debt equals financial strength and resilience in his view.
That's the core idea.
So how do we measure a company's debt level from the balance sheet?
The classic metric is the debt-to-equity ratio, or DE ratio. It compares total liabilities to shareholder equity. Generally, lower is better, suggests less reliance on borrowing.
But you need context, right?
Absolutely crucial. You have to compare the DE ratio to other companies in the same industry. Some industries, like utilities or manufacturing, naturally use more debt than, say, a software company. So context is key.
Okay. What about those current liabilities? Things like accounts payable money owed to suppliers and short-term loans.
Benjamin Graham put a lot of weight on a company's ability to comfortably cover these short-term obligations. He wanted to see a really solid cushion of current assets compared to current liabilities.
And there are specific ratios for that.
Yes. The main one is the current ratio. You calculate it by dividing current assets by current liabilities. Graham liked to see this ratio at 2.1 or higher.
Meaning twice the liquid assets as short-term debts.
That's the idea. It suggests a good buffer. Then there's the quick ratio, sometimes called the acid test ratio. It's even stricter.
How so?
It subtracts inventory from current assets before dividing by current liabilities. The thinking is that inventory might not always be easily or quickly converted to cash.
Okay.
For the quick ratio, Graham generally looked for at least 1.1. These ratios basically give you a quick check. Can the company likely pay its bills over the next year?
You mentioned earlier Graham's warning about off-balance sheet liabilities.
Ooh.
What exactly are those and why should we worry?
These are obligations that don't show up directly on the main balance sheet but can still represent a real financial burden for the company. You usually find them buried in the footnotes to the financial statements.
Like what kind of things?
Things like long-term operating lease commitments, potential liabilities from ongoing lawsuits, contingent liabilities, or maybe underfunded pension plans for employees.
Sneaky.
Yeah, Graham really hammered home the importance of reading those footnotes carefully. You need to dig to get the full picture of what the company owes. Ignoring these hidden liabilities can give you a seriously misleading view of their financial health.
Absolutely critical advice.
Oh,
Always read the footnotes. Okay, let's move to the final piece of this balance sheet puzzle. Shareholders' equity.
right. Shareholders' equity is basically the owner's stake in the company. It's what would theoretically be left for shareholders if the company sold everything it owns and paid off everything it owes. The net worth from the owner's angle.
And Buffett, again, focuses on consistently rising retained earnings within that equity section. Why is that specific part so important?
Retained earnings represent the profits the company has made over the years and then reinvested back into the business instead of paying them out as dividends. For Buffett, seeing retained earnings consistently go up is a powerful sign.
A sign of what?
It shows the company is profitable, which is good. But crucially, it also shows it's effectively using those profits to fuel more growth and build more value for the owners over the long term. It signals internal, sustainable growth.
Okay. And can you clarify the difference between, say, paid-in capital and retained earnings within that equity section?
Sure. Paid-in capital is the money shareholders originally put into the company, either at the start or through later stock offerings. Retained earnings, like we just said, are the profits the company generated itself and kept.
And ideally,
You want to see retained earnings becoming a larger and larger proportion of total equity over time. It means the company is increasingly funding its own growth through its operations, its own success, rather than having to constantly go back to the market for more cash from investors.
that makes sense. Okay, we've broken down the main components. Now let's talk about using ratios derived from these numbers, like the great investors do, to get deeper insights. Can you give us a quick rundown of some key categories and ratios?
Absolutely. Ratios are powerful because they let you standardize financial data. You can compare a company to itself over time or to its competitors. We can group them into, say, liquidity ratios, solvency ratios, and efficiency ratios.
Liquidity being short-term health.
Exactly. Ability to meet those near-term obligations. We've already mentioned the current ratio and the quick ratio.
Right. Any others in that bucket?
Another important one is the cash conversion cycle. It measures how long it takes a company to turn its investments like inventory into actual cash coming in from sales. Generally, a shorter cycle is better. It means better efficiency, better cash flow management.
Okay. And solvency ratios. That's about long-term stability.
Precisely. Can the company meet its long-term debts? The debt-to-equity ratio we discussed is key here. Others include the debt-to-asset ratio, which looks at what percentage of assets are funded by debt. Lower is usually better. And the interest coverage ratio. Now, this one uses earnings from the income statement, but it tells you how easily a company can cover its interest payments with its operating profit. A higher number means more breathing room.
Got it. And the third category, efficiency ratios.
These tell you how well the company is using its assets to generate revenue. We touched on fixed asset turnover and inventory turnover already.
Yes.
There's also total asset turnover, which looks at all assets, not just fixed ones, and receivables turnover, which shows how quickly they're collecting those customer payments higher, is generally better there too.
You also mentioned profitability ratios earlier, like ROA and ROE. They're mostly income statement driven, but how does the balance sheet play a role?
Well, return on assets,
Yeah.
ROA, and return on equity, ROE, measure profit against the assets or equity used to generate it. So the balance sheet figures assets and equity form the denominator, the base, for those calculations. ROE, return on equity, is a particular favorite of Buffett's. It shows the return the company is generating on the capital the owners have invested. A high and sustainable ROE is often a sign of a great business.
So it's clear just looking at one balance sheet for one period isn't enough. What are the broader methods these investors use?
Oh, absolutely not enough. Trend analysis is vital. You need to look at the numbers and the key ratios over several years, 5, maybe even 10 if you can. You're looking for consistency, for positive or negative trends. Is the financial health improving? Worsening? Stable?
Consistency is good.
Generally, yes. Consistent positive trends are obviously what you hope to see.
And comparing to others is important too, right?
Essential. You always need to compare a company's ratios to its peers in the same industry. As we said with debt, what's normal for one industry might be totally abnormal, even dangerous, for another. You need those industry benchmarks for context.
Now, Philip Fisher, he added a qualitative layer with his scuttlebutt method. Tell us about that.
Yeah, Fisher was brilliant. He believed the numbers only tell you so much. His scuttlebutt approach was all about going beyond the financial statements. He'd talk to people connected to the company.
Like who?
Customers, suppliers, competitors, industry experts, maybe even former employees. Anyone who could give him insight into the company's real strengths, its brand reputation, the quality of its managers, its competitive position.
So real-world checks on the numbers.
Exactly. This qualitative digging could either confirm what the numbers suggested or sometimes raise serious red flags that weren't obvious just from the balance sheet. It's about understanding the business behind the numbers.
Okay, finally, let's talk red flags. Those warning signs on a balance sheet that scream, be careful. Peter Lynch had some specific things he looked out for, didn't he?
He did. Lynch wasn't a huge balance sheet fanatic compared to Graham, maybe, but he definitely watched for things like declining revenue growth, worsening earnings quality, like profits coming from one-off things, not core operations high, or rising debt levels. Any sign the company's competitive edge was eroding, and of course, indications of poor management.
And Buffett, we know he worries about debt, but also those hidden liabilities.
Yes, exactly. Buffett is extremely wary of things that aren't obvious on the surface. Unfunded pensions, complex off-balance sheet, deals things that could represent huge future claims on the company's money that an investor might easily miss.
So just to summarize, are there any general red flags anyone analyzing a balance sheet should keep an eye out for?
Yeah, definitely a few key ones. Be very cautious if debt is ballooning without a matching increase in valuable productive assets. That's a big one.
Yep.
Another warning sign. Reported profits look okay, maybe even growing, but the company's actual cash balance is steadily shrinking. That mismatch often points to problems with earnings quality or cash flow.
Tricky.
Also, watch out for accounts receivable or inventory growing much, much faster than sales. That often signals trouble ahead, like we discussed. And finally, large and growing intangible assets, especially goodwill, that don't seem linked to a real, provable competitive advantage that definitely warrants skepticism.
Wow. This has been incredibly insightful.
Yeah.
A real deep dive into the balance sheet. It's so clear now why understanding this statement is just fundamental to getting a true picture of a company's financial strength, its resilience, its potential for lasting success.
Absolutely. And as we've seen through the lens of these great investors, it's not just about the numbers in isolation, is it? They combine that rigorous balance sheet analysis with a really deep understanding of the actual business, its industry, its management. It's the whole package.
Right. So the question for you listening is, now that you have this framework, this way of dissecting a balance sheet, what surprising things might you uncover next time you look at one? What critical questions will you start asking about those numbers that maybe looked simple before? That's the real power here. Thanks for joining us on the Deep Dive.